Welcome to episode 8 of the Students of Real Estate podcast. Today we are joined by Michael Olson, the managing principal at Rhino Capital Advisors and a Bentley alum. Michael, thank you so much for joining us.
It's my pleasure. Thank you for having me.
Absolutely. So for those who don't know, I'm Lorenzo. I'm a junior and the VP at the real estate group.
And my name's Adam Fuller. I'm a senior advisor at the Bentley Real Estate Group.
Awesome. So Michael, we'll just start off by asking you, can you tell us about yourself, where you grew up, where you're from, and kind of what led you to Bentley?
I'd be happy to. So I was originally born and raised in the Bay Area of California. In high school, my family moved to Connecticut. I always knew I wanted to go to school back east, so it was good to get used to New England winters before I started college. My grandfather actually went to Bentley on the GI Bill back when it was just a small accounting school on Boylston Street. And so that's how I was somewhat familiar with Bentley and applied and thankfully got in 2000 and had a wonderful experience there.
Incredible. So next up, I just kind of want to ask how you were as a student. Like, were you forward-looking? Were you really focused on the day-to-day? What was, were you already interested in real estate? What kind of led you to real estate? Just talk about your journey, and your time at Bentley.
Sure. So I was a terrible student. Unfortunately, I knew I wanted to get into real estate. And the reason why was I mentioned earlier, I was born and raised in the Bay Area, California. And every elementary school filtered into the same junior high school and met all new friends based on playing sports and other things. And in the Bay Area, it was an interesting dichotomy, given folks made a lot of money in tech and other things where you had extremely wealthy people and then you had middle-class folks like my family. So I kind of had a feeling of who was wealthy and who wasn't, but I obviously had no idea what my friends' fathers did. But I knew my one buddy, his family had a lot of money, and called me one Sunday and said, my dad has an extra ticket to the 49ers game. Would you like to come with us? And I said, that'd be fantastic. His dad picked me up in a Bentley, and we were rolling down the highway, and his dad would be pointing at buildings saying, guys, I own that. I built that. We go to the 49ers game. Again, I still have no idea what this gentleman does for work. 49ers end up beating the Rams. We get back in the car. We're driving back the highway. He said, fellas, I'll take you out to dinner, but I have to stop in my office real quick. We were hemming and hawing. So they pull into a technology park in Palo Alto, California. And it's about a 60,000 square foot building. We come around back. There's a big tractor trailer truck that says Mozart Racing on the side. Their last name was Mozart. And I'm still wondering, what the heck does this guy do for work? He opens up one of the loading docks, and about half of that building was a showroom for all of his cars. He had a Batmobile from the original Batman movie, Aston Martins, Ferraris, pictures of him and Jay Leno and him and Ralph Lauren on the wall. My jaw was just on the floor. Then we get back to the rest of the building, which was his real estate development operation. And so I went home that night. I asked my dad what he did for work, and about 30 seconds into that conversation, I decided I'm going to go do what Mr. Mozart does. So throughout my college career, I really, really wanted to get into real estate. And my grandfather had helped start a company called Federated Investors. He actually earned an honorary doctorate at Bentley. And so all my internships were at Federated, which is very far away from being anything real estate related. But coming out of school, I really, really wanted to get into real estate and started knocking on doors of all the big firms. And it was that classic catch-22. They wanted somebody with experience, but really didn't have a good handle on how you could go get that experience. Bentley has a wonderful career services group, but back then they really didn't have a lot of avenues to get involved in commercial real estate. Very different from accounting, where you really have that path laid out for you of what you can go work for the big four, and then, et cetera, et cetera. Real estate's much more amorphous, and you really have to pave your own way. So thankfully, I wanted it bad enough where I was knocking on every door I possibly could. Finally got my first job at a place called One Beacon Insurance. And the real estate department consisted of the head of real estate and then myself. And he was tasked with taking 1,400 Massachusetts employees and putting them all under one roof. They were, at the time, I think, in 4 different locations. And so I got to be involved in the acquisition, the design, the development of a brand new corporate headquarters in Canton, Massachusetts, which was about 260,000 square feet. it was an incredible experience because my boss would sit me down and give me 5-minute tutorials to ensure that I understood all the crazy acronyms that we throw around in commercial real estate. Sit down with construction documents, make sure I understood that. Sitting down with a loan agreement, and make sure I understood that. Sit down with a lease and make sure I understood that. So it was really my master's in real estate and a wonderful, wonderful opportunity to really kickstart my career. From there, I segued that into go working for JLL, a global commercial real estate firm. I had various roles there, from research to capital markets to leasing. Wonderful experience, gave me an opportunity to really expand my network. If there's one thing I'd leave our viewers/listeners with, is real estate, specifically Boston real estate, is very much a relationship business. And so establishing as many relationships as you possibly can is so vital. I'll leave it there and let you guys ask your next question. But that was my progression of getting into real estate, and very thankful it went the way that it did.
Yeah, that was one of the best stories, I think, from what we've heard of that was in San Francisco, and being able to see all those buildings. That was really a big shock, and probably one of the most not dramatic, but something that sticks with you types of stories.
It definitely did, and being able to point to something tangible and to bring it full circle. I now drive down the highway. I've got 3 boys, 13, 11, and 9. And they'll be in the back of the car. We'll be driving to Cape Cod. My wife will be sitting next to me, and I'll point at a building and say, "We own that building, and you'll never believe what they're doing inside there." And it's, yeah, we don't care. But it really is fascinating, and one of the great byproducts of what we do is you get to learn about these companies that occupy space that we either own or we've developed. And it's fascinating. There's so much innovation that's happening in this area of the world. And these buildings admittedly look pretty bland from the exterior. But what's happening on the interior is nothing short of remarkable. And we're thrilled to be a part of it. I'm sure you guys were feels a little bit when I started the conversation with I was a terrible student. So hopefully I brought it down very positive.
No, that's a super fascinating story. I love it. And you went to the other question that we were going to talk about, just your first few years out of Bentley. What the roles were, JLL. So, like you said, you spent the time at One Beacon Insurance and then JLL, and then what did you do for the next few years before starting Rhino Capital?
Yeah, I always had in the back of my mind that I wanted to be like Mr. Mozart and have my own firm. So thankfully I had the opportunity with some family money to go and whet my appetite to be on the principal side of the business. So I started by buying an apartment building in the Beacon Hill neighborhood of Boston. Lived in it, fixed up the units, and really learned that real estate investing is just blocking and tackling. There's no degree that you need to earn from Bentley. There's no certificate that you need to get. You really just need to go do it. And in doing it, I made a lot of mistakes, but I also got a lot of confidence that, hey, this isn't rocket science. There's no secret sauce. You just have to go and do it. It's a very experiential business, meaning you have to go experience it. You're not going to learn it reading a book. You're not going to learn it by talking to people. Those things are important, and I would recommend that you do it, but just jumping into the deep end and doing it is really important. So that gave me the confidence to say, all right, I do want to go do this. I didn't really have a path of launching Rhino Capital, but I knew that's what I ultimately wanted to do. I ended up having my first child with my wife and had a very cathartic experience while I was at JLO, which was a wonderful experience, and realized very quickly this isn't the trajectory that I put myself on when I was riding around with Mr. Mozart and he was pointing at buildings. And so I actually gave my notice that I was going to quit without even having my next thing lined up. I was buying this was coming out of the global financial crisis for context, 2011, and was buying homes in Phoenix, Arizona. Homes that were trading for $500,000, we were picking up for $60,000. I had a very good friend that went to Arizona State University. He was our boots on the ground, and together we were assembling a portfolio. So I at least had something that I could spend some time on in addition to some of the apartment buildings that we were buying in Boston. But still knew that I wasn't quite ready to launch Rhino Capital. Thankfully, one of my clients, the Grossman companies, reached out and said, hey, what are you planning on doing? And I said, I honestly don't know yet. I just knew that JLL wasn't the future for me, and I really want to be on the principal side. They said, come work with us. They were a nimble, entrepreneurial, I think 4th generation real estate investment and development firm. And very good friends of mine that I had initially met through some industry groups in Boston, like NAOP and REFA. And that's another thing that I would impress upon the listeners here is joining some of the industry groups, real estate related, in Boston is a wonderful way to expand your network of like-minded individuals. And the other wonderful thing about Boston real estate, which I don't know enough about the rest of the country, but I know, I believe that Boston's very unique in this, in that a lot of the very influential people in Boston real estate go to these events and will spend time with young people. They're not locked behind a door in their ivory tower. They're getting out there and they're interacting with people. So again, it's a wonderful way to instantly build credibility and meet some very influential people that can help you along with your career. But getting back to the story, I ended up going to work with the Grossman companies and had every intention of being there for several years and winding down my brokerage activities and ramping up my acquisition activities. And having the credibility and the calling card of somebody who had been around for several decades, I felt would enable me to look at some different investment opportunities that would be much more challenging to look at if I just started on my own and went out there. Thankfully, we found a 4-building portfolio off-market, and off-market means that it wasn't being marketed. Put it under agreement with the Grossman companies. Grossman companies decided they didn't want to do it. I had the audacity at the time to say, I think I'm ready. I want to do this on my own. I just had my second child. I talked with my wife, and she said, if we're going to do it, we might as well do it now. And that was the launching of Rhino Capital. I had a portfolio that I could work on, had permission from the Grossman companies to pursue it. They were wonderful. I'm still very good friends with those guys. Incredibly in debt to them for how wonderful they were throughout that process. They would have been well within their rights to say, no, we don't want you to do that. But we're extremely supportive. And again, I'm beyond grateful to them. We recently celebrated our 10-year anniversary and they were there, and it meant the world to me that they were there. But that was the launching of Rhino Capital. And one thing that, again, I'd share with folks is if you are interested in going out and doing things on your own, find a deal. Once I did that one deal, which wasn't even that big. For context, it was $15 million. That gave me instant credibility. And then the snowball effect starts. Again, there's no permission that you need to be granted in order to get out there and start doing your own investment activities. There's no certificate that you need to earn, no degree. You just have to go do it. And the fact that I had done it and could point to it and say, I own those 4 buildings, launched Rhino Capital and enabled us to go out and continue to build a portfolio.
I think that's an awesome story. I think, that's super inspiring. I think that, both Adam and me and every student would love to do something like that. And, I think the big question is, how were you able to raise the capital to buy that deal?
Great question. So I had been doing some activities prior with friends and family, so folks at least knew that this wasn't my first foray into it. Definitely was a little bit bigger of a purchase price. The one thing I'll mention too is just because a deal's bigger doesn't mean that it's more complex, doesn't mean that it's more challenging. Oftentimes I found the bigger the deal is, the easier it actually is to go get it capitalized and manage on the back end. And the reason for that is you're able to deal potentially with more sophisticated folks. I know one of the questions you guys wanted to ask is what are some of the differences between high net worth syndication raises versus institutional capital raises? Well, the big difference is if you go to an institutional capital source, it's one check. It's one person that you're dealing with. When you do a syndication of high net worth individuals, you'll have anywhere from 1 to, in some cases, our deals, we have 150 people that are involved in that transaction. So there's a lot of challenges that are associated with doing a high net worth syndication, but there are also challenges with working with an institutional capital. So how I raised that deal, we actually bifurcated it. It was 4 buildings, and we did 2 and 2, so two mini portfolios. One of the portfolios, we went to an institutional capital partner, got them to sign off on it, and so that was one check that they were able to provide, and then we funded the GP position. In all of our capitalizations, we've got a general partner position, which Rhino Capital sits in, and then you have a limited partner situation where it's either an institutional capital partner or in the case of the other 2 buildings, which is the other mini portfolio we created, was a syndication of high net worth individuals. So we just reached out to our stable of folks and said we really like this deal. It was cash flowing. We were going to be able to distribute cash flow on a quarterly basis. Folks really liked the story, and we were able to raise that money. And again, for context, about a $15 million deal, we raised about $5 million of equity capital from an institutional capital partner on 2 of the buildings, and we raised around $2 million for the 2 smaller buildings that were cash flowing. So it was great to see both sides of the spectrum on how to raise capital for those deals. And then we actually had one lender that gave us debt over all 4 buildings, so that made it a little bit easier on that front versus having to work with multiple lenders.
Got it. Wow, that's awesome. And and I have so many questions now, but I'm gonna go slowly. You know, obviously, when you start off your investment firm, it's all about credibility and your reputation, right? And so, how did you kind of this is what everybody goes through, being the new guy in town. How did you deal with that challenge of being the new guy in town? Raising capital, getting a lender, getting investors, whatever that involves.
Great question again. I didn't necessarily feel like the new guy in town, thankfully, because I had been involved in Boston real estate at that time for around a decade. So I at least felt like I wasn't jumping into the fray, not having relationships that I had established over time. So I definitely leveraged the relationships that I had built up over the previous 10 years. Coming out of the brokerage community, I was a broker at JLL. I had wonderful relationships with brokers that were more than happy to help me in sourcing investment opportunities, providing me with market information. So I didn't have to go and establish all those relationships. They were already pre-existing for me. With some groups that are maybe more nationally focused and they fly into Boston, it's pretty hard to ramp up because you have to go and you have to establish all those relationships. So made a decision early on, I'm going to focus on this geography because I've already established a lot of relationships here, and I'm just going to continue to invest here. Thankfully, Boston's continued to be a wonderful place to invest in real estate. Even during the downturns like the one I believe that we're coming out of right now, values have held. The velocity of transactions definitely goes down, but there's not the proverbial blood on the streets like there is in some other markets across the country. And why that is a variety of factors. It's the universities we have, the hospitals, the innovation I mentioned earlier, the skilled labor force that we have here. So thankfully I picked a good place to start an investment firm and being able to ramp up here and leverage those relationships. In addition to that, I wasn't necessarily a trendsetter. There was almost, I'd call it a graduating class of folks that were roughly my age and my experience level that started their own investment and development firms right around the same time. So there was a bunch of other people doing similar things to what I was doing. So I didn't feel unique. I didn't feel like I, again, was an outlier. I actually was with a group of people that were doing the exact same thing, that were roughly my experience level and my age. And we didn't consider each other competitors. We actually considered each other collaborators. So we were buying and selling buildings from each other for quite some time, and it ended up working out great.
So essentially my question was just what avenues can students take right now, maybe if they don't have, let's say, the capital, the resources, the time, whatnot, to really get started in real estate. What are some of the best ways, best avenues to build key skill sets, whether that's within roles, whether that's just here's a few things to really dig down on and learn if this is what you want to get into. Where's the best place to really get started for someone like that?
Definitely don't make the mistake that I did. Start establishing your relationships while you're at school. As you're experiencing right now during this podcast, people love to talk about themselves. So ask for informational interviews. Say, hey, I'm not looking for work. I'm not asking you for anything other than I'd love to hear about your experiences because I'm trying to navigate how I can start what I want to do in real estate. What I share with young people is I feel the commercial real estate and a lot of other industries too, it's almost like a pyramid. And if you can pick, this is the tip of the pyramid that I'd like to get to. Somebody like Michael Olson, I like what he's doing on a day-to-day basis. I'd like to ultimately get there. The reassuring thing is there's not one track to get up to that tip of the pyramid. It's not I got to start here and then I got to get here and then I got to get here to get there. The base of the pyramid is extremely wide. There's a bunch of different tracks that you can go down and still end up in the same destination. So, my advice to young people is just get into the industry. It's a very challenging industry to get involved with. However, you can navigate your way into it is worthwhile because it's I don't want to say it's irrelevant, but just getting in the first 2 or 3 years, you're going to be learning anyway. So as long as you're getting exposure and you're building credibility and saying, "Hey, I'm in the industry now," it's worthwhile. As you mentioned, commercial real estate in general, it's very challenging because we don't really have a lot of entry level positions for folks. We don't go hire a graduating class like accounting firms do and investment banking firms do. You really have to pave your own way. So how you do that is get out and talk to as many people as you possibly can. In addition to that, I mentioned it earlier in this podcast, join some industry groups like NAIOP, like ULI, like REFA. It's relatively inexpensive for students, and you can get in a room of 100 to 200 people that are like-minded and folks that might ultimately hire you, or at the very least are going to be a resource when you have questions that come up. And then I encourage people, just go buy a deal. I know it's a lot easier said than done, but there's no set track that you need to go on. Again, there's no certificate, there's no degree that you need to start doing it. It could be as simple as buy a condo and rent it out, buy a triple decker, team up with a couple folks and go buy a small building. If that's your passion, your purpose, and what you really want to do, there's no better time to start than right now. There's no like, oh, I need to do this before I can go do that. There are tons of people that are your guys' age that are already jumping into the fray and investing in real estate, and any experience is worthwhile. As I mentioned earlier, just realizing that it's a lot of blocking and tackling and just getting in and doing it, it's better to start sooner rather than later. I do advise folks, obviously, if you are working for somebody else, make sure that you're allocating all of your efforts into doing that. But it is something that you could potentially do on the side, on your weekends, your evenings, things like that. But if you're looking to crack into the industry, get out there and talk to as many people as you possibly can. Don't make the same mistake that I did and wait until after you get out of school. Start while you're in school. And I guarantee you, people are going to be more than happy to allocate time to you, share their experiences, and hopefully be helpful.
All right, no worries. Yeah, so I guess that challenge is really, just trying to find the balance between the, preparation versus execution, and some people waiting too long and trying to overanalyze everything, get everything together, feel like they're fully prepared, fully confident to go in and get started, which, of course is important to a degree, but at the same time, you got to take action. So I love that perspective on it. I don't know if you want to continue a little bit further. Looks like you were about to say something.
Well, I was just going to say, I think you hit the nail on the head. It's all about action execution. There are a lot of people that I've been talking to for more than 10 years that are saying, I'd love to get out and invest in real estate, and they're still sitting on the sidelines. You're never going to find the perfect deal. Every single deal is going to have risks associated with it. And I believe you're better off going and making an investment decision and moving forward and starting to execute and take an action versus waiting for the ideal time, because I don't believe it's ever going to present itself. You're better off if it's your passion or purpose and something you want to do for the next several decades. Again, there's no better time to start than immediately.
Can you guys hear me now?
Perfectly.
So sorry about that. I wanted to ask you, I said that I love that you mentioned that you can just jump in and do it. There's not really steps that you have to go through, because I feel like, that's kind of the path that, I'm at personally, and Adam and a bunch of other kids are at in Bentley that are very passionate about real estate. And, but a lot of people around you tell you, oh, no, you have to do this first, and then this, and then this, and then this, and then maybe I'll give you some money so that you can raise. So 'cause it's all about credibility, right? So, I'm curious. You said, network, right? Meet as many people as you can. But then you also said the deals, find the deals. So would you say you got to focus on both? Is it a mix of both, or focus just on one? Or how does that work to find your first deal and start your business?
Well, I think those two things are synonymous. Your network is going to lead to identifying investment opportunities. Whether you're talking with a broker that has an investment idea, whether you're talking to an owner of real estate that's willing to sell. So I really think those two things go hand in hand. The more people you're going to meet with, the more folks are going to be in your network that might share an interesting investment idea. So, again, I think those two things go hand in hand and should focus on them simultaneously.
Got it. I want to jump back into the Rhino Capital and your progress. So you did your first deal, your $15 million multifamily deal, correct? Apartments. And so, how
It was
did
actually
you?
a four-building portfolio of office and flex buildings. Sorry.
Got it. So how did you kind of build the team around that? Because obviously that's a big property, right? Multiple properties, like you said, and you got to have property management. You got to have staff on site. You got to
Yep.
have the whole thing, right? So how did you kind of build that and manage that?
Partnered with my friend. So my friend had already built out a lot of that infrastructure, and so partnered with them. And so they supplied the property management resources, so I didn't have to staff up to be able to do that. And early on, we third-partied as much as we possibly could, whether it was on the management side, bookkeeping, anything that we could third party, we did, so didn't have to take on the overhead risk. As time went on, there's a firm called National Development, which is a misnomer in that they focus just primarily here in New England. But they were always my North Star. I really wanted to be like them. And the reason why I wanted to be like them was I felt that they could evaluate and execute on any real estate project in New England. And I just thought that was fantastic and wanted to build a similar style firm. And so I had that blueprint in my mind as we went and we started building out the team. What's vital for us is less so skill set and more so values. You mentioned earlier reputation, credibility. Boston's a very tight-knit city, and the commercial real estate community within Boston is even more tight-knit. So having the folks that are going to do the right things when nobody's looking was way more important to me than having each individual skill set perfect. The best compliment I give, and I give it to some of the young people that work with us, is that I want my children to grow up to be exactly like you guys. And I feel that way about the folks that work alongside me. So again, it was less so I need this skill set alongside me to be successful. It was way more rooted in values because I felt like people could get ramped up relatively quickly and learn how to do the necessary functions that we needed to be a successful operation. But the way we did it was we partnered early on with folks that really already had the infrastructure built out to manage properties, to execute on our business plans, and then over time found the right people with the right values to come join Rhino Capital. I should mention we're a team of 10 people. We work in Boston. What's unique about us is we do have an in-house development team. So a lot of other firms don't have that in-house capability. We felt like that skill set was really important to have to be able to entitle and permit land to go build buildings, obviously ultimately to build those buildings, but even more importantly, to build out spaces. We have a mantra at Rhino where we want your real estate situation to match your business needs. So our development team goes on property tours with prospective tenants and asks a lot of questions about how they're going to utilize the space. And we don't put together cookie cutter spaces. We put spaces together that are unique, that are going to be a good fit for whatever that company may need. They might need a clean room. They might need manufacturing area. They might need a certain amount of power to function their equipment. All that stuff are things that we ask the right questions to get the right answers, and then ultimately they're occupying space that fits their business needs so their business can flourish at the end of the day.
Yeah, I think that's incredible, especially like value proposition on that end, being able to have that level of control within the construction management aspect and getting the properties ready for whatever tenant and being able to kind of customize that experience. You did mention early on, I just wanted to kind of dive into this a little bit, that you were using a third-party property manager. Now, as owner operators, are you guys still, do you take control over the entire process, like completely vertically integrated? Are some properties a little different of a story? Do you have still, reliance on property management? Just kind of, I wanted to talk through that either transition or kind of how the current makeup is today?
We still third-party property manage everything. We're thankful to be aligned with great third-party property managers. We use one group for our multifamily portfolio and another group for our commercial portfolio. And our commercial portfolio is a lot of industrial buildings. Our definition of industrial is different than other folks. I think some people hear or say industrial and they think warehouse building. Our definition of industrial is much more broad and includes manufacturing facilities, flex facilities, and we've had a lot of success more so in that product type than focusing exclusively on warehouse. We do own warehouse buildings as well. Those leases in those buildings on the industrial side are what we call triple net, and so the tenant is paying for all operating expenses, real estate taxes. I don't want to say they're easier to manage, but it's definitely different. So we still use third-party managers for that, with the exception of a handful of buildings that are absolute triple net, and we manage those in-house. It's much less responsibility for the owner, much more responsibility on the tenant to operate the building, and so we feel like we're equipped to do that in-house. The reason we've done that is just to be able to keep headcount down and be able to hire the right firms. We also do that on the construction side. So although we have in-house development people, we third-party all the construction work, and we'll hire the right general contractor for whatever the job is. We have a handful of general contractors that we work with, and depending on the job, we'll align ourselves with those folks, and they'll either build a building, they'll build out space for us, whatever needs to happen. We're definitely not a group that's just out to get the best price. We're actually the group that wants the best value, so we get the outcome that we want.
Got it. So we've talked about, many different, development, property management, construction, all that kind of stuff. I want to focus more on your investment thesis and what you guys focus on as a firm. So more specifically, well, obviously market is it greater Boston, and also what type of properties and what type of investments in terms of, core plus, opportunistic, that sort of thing.
So in terms of the risk spectrum of core plus, opportunistic value add, we play across that spectrum. Our investment thesis is really to continue to align ourselves with the leasing brokerage community, not necessarily the sales brokerage community, but the leasing brokerage community, and we chase their best ideas. We have, like I mentioned earlier, focused primarily on the industrial universe, and the sandbox that we play in, or the geography that we play in, is what we affectionately call Greater Boston, but that includes Southern New Hampshire as well. We'll look at deals in Rhode Island, we'll look at deals in Connecticut, we'll even look at some deals in New York. But if you look at our website and see our portfolio, it's primarily inside of that 495 belt and going into Southern New Hampshire as well. The types of deals, or the size deals, I should say, that we look at, I would call middle market deals, where we want to stay above the mom and pop investor on a total project cost size, but we want to stay below the institutional investors. And so to quantify that, our average deal size right now is probably $20 million. We bought last fall a $3.3 million building, and last summer we bought a $60 million building. So the spectrum is pretty wide, but our average deal size is $20 million, and that puts us, again, above the mom and pop guys, but a little below the institutional guys. And that's where we're finding the most value, and even more importantly, deals that we can do off market. Those deals aren't typically marketed. We have done marketed deals that get blasted to 1,000 different people across the country, and they look at that. But where we're most successful is off-market opportunities that aren't being marketed, that we're able to manufacture something or we have an angle on. For instance, this past summer, we bought a vacant building, but we had a tenant that wanted to lease it up. So we bought it from a corporate user that didn't need the space anymore. And then we had the tenant and signed that lease simultaneously while we were buying the building, and then ultimately built out the space to meet that tenant's needs. So those types of opportunities are where we feel our secret sauce is and where we like to gravitate towards.
Awesome, thank you. I want to dive a little bit deeper into the construction management aspect of it. Just get a bit more granular. Can you talk through maybe even an example? But how the decision-making process works within the construction and development side, especially preparing for a new tenant to come in. Obviously, what considerations are you taking from them, or what do you feel that they need? What are they communicating to you? And then to what extent is that communication playing into the end result, and essentially how much money goes into doing that, and how much they're going to be paying for rent. How does that all kind of work together to come to fruition?
So the construction side of it is definitely not my area of expertise. So forgive me that I'm not going to be able to probably give you as much as some of my teammates would be able to supply. But I mentioned earlier that our construction development guys are on every single property tour. So as we're getting close to signing a lease, like I mentioned, they're going to be asking a lot of questions. For instance, we had a tenant come to us one time and said, we need X amount of power to be able to operate our equipment. We brought our consultants and engineers to the table, started asking the right questions of, well, when are you operating this equipment? What actually needs to happen? Because supplying more power to the building was going to be pretty costly, and ultimately the tenant was going to have to pay for those costs. So through asking some questions, through our consultants doing some calculations, we realized, all right, you don't actually need that much power. You can operate under much less power, and therefore it's going to cost less to get you the space that you need, and therefore you don't have to pay as much rent. Depending on how you structure the deal, you're going to give a tenant improvement dollars, and we might do the work to build out their space. They might hire somebody to do the work to fit out their space. And in addition to that tenant improvement dollars, there's going to be some landlord work that needs to get done too. And so that gets negotiated as you're putting the lease together. All right, tenant, this is your responsibility. You're going to be building out some offices. Landlord, your responsibility. You either need to increase the power, or you need to make sure that the HVAC units are in good working order. And all that gets negotiated throughout the lease. And then it's really just a math formula at the end of the day. What return on cost do you want to get to? And that's based on a variety of factors. And we figure out it's going to cost us X between the tenant improvement allowance and the landlord work. And then we need to charge this corresponding rent, which more often than not aligns with where market rents are. And then we move forward from there. I'd say that process from start to finish could be as quick as 30 days, more likely 3 to 4 months. To put everything together, and then once you build out the space, it's going to be anywhere from 60 days to 6 months to get a tenant in. We're finishing up a build out right now that took about 4 months. It was very specific to that tenant's needs, pretty involved, and we're delighted on how it turned out. There's a very rewarding feeling when you actually put all that planning together, go and actually build the building or build out the space and see the tenant move in to operate their business. Again, it's very rewarding and satisfying to see at the end of the day.
Absolutely. You're creating the spaces for someone, you're adding value to their life, and therefore they're able to, continue that and operate their business and contribute to the world. So I guess a kind of side question off of that would be, have you ever said no to any of those requests or those build outs, especially also kind of considering what the lease term would be? Can you just talk how that would kind of play into things?
Yeah, I wouldn't necessarily say that we've said no, but it's definitely a negotiation, and more often than not, we're sharing our knowledge to help that tenant or whoever we're working with to get to the right answer. So they come in thinking, I need these things, and through asking questions, through, again, sharing our knowledge and our experience, sometimes we're able to move them off of that position to say, actually, this would be a better situation for you. You don't either need that much power, or you said you needed 4 loading docks, but we just realized you really only have 1 delivery every day, and you don't need 4 loading docks for that. You really only need 1 loading dock for that. So I don't think it's a flat out, no, we're not going to do that. But there are negotiations that happen on a daily basis to get to yes and get to execution. There are certainly situations that have been presented to us prior to our engaging where we just said that's not for us. Either the price is too much or the tenant credit isn't good enough. We figure that very early on, though. We're not at that point in a negotiation. But we're obviously not saying yes to everything that crosses our desk. We're definitely saying no to deals. What we pride ourselves on, though, is we give an answer why. We don't just say no and move on to the next one. We say, know, and here's the reason why we got to know. Like I mentioned, either the tenant credit isn't there, or we think the price is too much to buy the building, or it wouldn't work. Again, a whole huge variety of reasons why we get to that. But when we're in a negotiation, when we're working through designing space for somebody, it's such a collaborative effort. It's rarely a situation where we're drawing a line in the sand and just saying no.
Awesome. So I want to shift a little bit more towards the current market and the economic climate. Just get your opinion on it. What do you think? What do you think of the current market and its impact on real estate, and more specifically on interest rates, the new administration, any policies that they're bringing on, and also, more specifically on Boston. I've seen a bunch of news on, zoning regulations. For example, in Cambridge, they just changed the single family dwelling. Like now you can build up to 6 units, I think or not 6 units, 6 stories, I think it was. So yeah, just kind of talk about that.
So there's a lot to unpack there. Let's start with interest rates. So the story I like to tell people is not that long ago, we signed up a deal at a 2.8% interest rate. We're going to close on a deal in the next week or so. That interest rate's going to be high 6%, so 400 basis points or more higher. And that happened in the span of 12 to 24 months. So you've had a dramatic increase in interest rates that have impacted values dramatically. So that was hard for all of us to adjust to that. I do believe that it's normalized, for lack of a better word, where people at least have some visibility into what rates are going to do. I'm a believer that rates aren't going to shift downward dramatically. I'm also humble enough to know I have absolutely no idea what's going to happen with interest rates. And so how we operate is just with the information we have presented to us. Here's what the interest rate would be if we locked in today. Here's what the deal profile is. Can we do it or can we not do it? We're rarely in a situation where we say we're going to do this deal because we're predicting that interest rates go down by 200 basis points over the next 2 years. Just like we were doing deals 2 years ago, and nobody knew that interest rates were going to go up 400, 500 basis points in a short amount of time. And so, again, we just try to operate with the information that we have presented to us. One of the downsides of working for or with a local firm like us is that I don't really have a view of what's happening nationally. I'm very esoteric in my thinking to what's happening in Boston. So we'll tackle Boston right now. I do know enough, though, in talking with friends who operate around the country. We're very fortunate to be here in Boston. I mentioned the university system, the hospitals, all the innovation that's happening here, all the capital that's flowing through here. Funds are getting established, and Boston's written all over those documents. We want to be in Boston for all the reasons that I shared earlier. One of the reasons why real estate funds want to be in Boston, you touched on it a little bit, Lorenzo, it is extremely challenging to develop new product here in this area, whether it's Cambridge, whether it's the city of Boston, even the municipalities surrounding Boston. It is so challenging. And I'm saying that from experience of trying to entitle and permit new deals. It's just really, really hard. Neighborhood groups are well capitalized, they're smart, they're knowledgeable, they know what they want, but even more importantly, they know what they don't want, and they're not going to let you do it. And so you're not seeing a bunch of new buildings pop up all over the place here. And so for existing buildings, it makes you feel pretty good that you're not going to have a bigger competitive set to have to deal with, because buildings are going to, newer buildings, better buildings are going to pop up all around you. I'm not that political. I can't tell you whether I think it's right or wrong. I'm just telling you how it is, and I don't see that changing anytime soon. I do know that we have a huge housing crisis right now. Had conversations with the governor. I'm actually going to an event tonight with her, talking to the lieutenant governor. I do think they're very aware of the problem. I do think that they are doing their best to try to solve that problem. I think it's going to be very challenging to hit some of the metrics that they're trying to hit to create new housing supply for all the reasons I talked about earlier. Just the permitting efforts that we have in place in the city of Boston, Cambridge, around the state, make it really hard to develop stuff, whether it pencils or whether it doesn't pencil from an economic standpoint. So hugely challenging. But taking a huge step back, I'm very, very thankful that we're here. When I moved from the Bay Area to Connecticut, I was outside of Hartford, Connecticut, and I joke with some buddies there that if I started Rhino Capital and I was investing around Hartford, we would not have done very well. And that's only an hour and a half away from Boston. Boston is a wonderful place to be investing in commercial real estate. Our investment thesis, like I mentioned earlier, where we're staying as focused as we possibly can in the industrial universe, with our definition of industrial being pretty broad, not just warehouse, but other facilities as well. We're seeing a ton of value in that size range that I shared, being above the mom and pops, being below the institutional investors. And one thing that's not appreciated, we haven't touched on it yet during this podcast, is that Boston's very blessed with a very frothy local lending market. My best friend lives in Denver and does something similar to what Rhino Capital does. And when he's embarking on building a building, he can only go to two banks. Two. We put a slide together. We were going out on a road show and put a deck together, and one of the slides was, here are the local lenders that we worked with. And so our analysts started putting a list together of just banks that we worked with over the last 3 years. And the number got up to 37. We were working with 37 different banks. My buddy can go talk to two. We had worked with 37, and that wasn't even the full universe of local lenders that are here in the greater Boston area. I don't know how many there are, but it's at least twice as much as what we've worked with. And so they love to lend in that size range that Rhino Capital focuses on. Call it $5 million to $40 million. And so it's kept the velocity of transactions up because you can go to these local lenders and they can lend to their existing clients. And so it's enabled us to transact and be very active in an environment that over the last 2 years, not a lot of people did a lot of things because it was really challenging to put capital stacks together, more so on the debt side. So investing here in greater Boston, which again was something that I didn't have the foresight to know was going to be a dynamic, is a great place to be because there's a ton of debt capital from these local lenders that are out there, whether you are capitalizing a deal or whether you're trying to sell a deal, and the buyer can go out to that universe of local lenders and get debt in order to acquire your building.
So what did that look like, building relationships with all those different banks? I mean, especially starting out, obviously, like proving that credibility, being able to, get access money. But also, I wanted to ask kind of a separate question. Your strategy, as interest rates really dramatically changed, obviously, you mentioned if it makes sense on paper, we're going to do it regardless of the rates, make sure it makes sense. But was there any fundamental strategy shifts between that time?
So I'll tackle the first question, how we established those relationships. We were leveraging mortgage brokers at firms like JLL, like Newmark. We have an unspoken rule where if a leasing or sales broker from JLL or Newmark or other places like that bring us an idea, bring us an opportunity, we're going to engage their mortgage brokerage group. And they're going to go create a market for us. They put a package together, say Rhino Capital's looking for some debt, and they'll go out to that universe of local lenders and see if they're interested in working with us. And so that exponentially grew our network of lenders that we could work with. And again, very fortunate enough to be operating in this area of the world where you have that much debt capital at your disposal. Wonderful people in true relationship lending. With all due respect to the Bank of Americas and JP Morgans of the world, I think a lot of times there's a lot of turnover there and they just operate by the letter of the law that's in your loan documents. We can pick up the phone and call the presidents of these local lenders and say, hey, we're going to shift our business plan, or hey, we need a little bit more money because the tenant needs more funds to do the build out, but they're going to offset that by providing more rent. And in one phone call, you can get to a yes versus I'm sure there's a ton of red tape that you have to get through working with a bigger institution on a bigger deal. So we feel very blessed to be in that universe. When rates shot up in terms of did we dramatically change our strategy, the short answer is no, but what we realized very quickly was that buying multifamily buildings was virtually impossible. The cap rates that sellers were still expecting really didn't change much. So they were still in the 5% or less range. But debt capital, as I mentioned earlier, was in high sixes to sevens. And so you'd have negative leverage going into it, and everything would have to go right just to get to a point where you were breaking even. Versus we could go buy some industrial buildings for 8 or 9% return on costs and put debt of high sixes or sevens, and it would actually pencil in our pro formas. Our investors wanted us to go do things that actually penciled versus just buying multifamily buildings. Now, the folks that went and bought those multifamily buildings, I hope they do phenomenally well. They were typically huge funds that just had an allocation and had to buy multifamily buildings versus necessarily thinking that they were going to be home runs. Again, I wish nothing but success for all those folks, but Rhino Capital quickly realized that given the dynamics that existed with interest rates, with sellers' expectations in multifamily, that we were going to shift off of that investment thesis and focus much more on the industrial universe, which turned out to be a wonderful thing for us over the last 2 years.
Gotcha. I know we are kind of running a little over time, but I definitely want to hit on one last big deep dive, I guess, into how you deal with your investors. You mentioned between they're under the institutional, but above the mom and pop, which of course is the probably most unstandardized zone, at least to my understanding. So I was just wondering how that works, how you communicate with them, how the deals are structured, how they're, how that interaction really works between them.
Well, I should mention we do have institutional partners. We've established programmatic ventures with some institutional investors. So although the types of deals that we're buying are underneath the institutional folks, we still do partner with them. Okay. And we'll typically aggregate a few buildings to get there. Our typical structure is, I mentioned earlier, GP, which Rhino sits in, and then you'll have a limited partner or limited partners. On the institutional side, it's typically one limited partner. On the high net worth side, it's a bunch of different folks that sit inside of that operating agreement. How we deal with our investors, communication. Communication is the key to anything. We, on a quarterly basis, report to our investors, whether it's institutional folks or whether it's high net worth folks. So we have an investor portal. It's a busy time for Rhino Capital because we curate each individual report with a pretty substantial narrative, which touches on here's what's happening with your investment, here's what's happening in the market, here's reiterating our business plan of what we're trying to do, and it again is very involved because it's an opportunity for us. I call it's our advertising budget. It's our ability to showcase to our investors how much time and effort is going into ensuring that we're going to execute the business plan that we established as partners in this investment. So that communication is key. We've been very blessed that the vast majority of our portfolio performs the way that we expected it to. When situations do arise, and if you do enough, we have 32 active investments right now where things aren't going the way that you expected them to go, that's when communication is even more important. To share, hey, this isn't going the way we thought, and here's what we're doing in order to preserve your capital or to shift our business plan because we think that it's important to do so given what's been presented to us. And investors appreciate that. They understand that. We feel like bad news is best delivered immediately. And obviously with here's what we're going to do about it, not just, hey, this happened and too bad. It's here's what's happening and here's what we're going to do to mitigate the risks associated with them. When we're evaluating a new opportunity, we have a pretty good handle on what our investors are interested in. Again, through communication, we're constantly learning what's shifting for them, what are they seeing, what would they like to do, and this is probably more so on the institutional side. So it helps educate our hunting process for new investment opportunities. If we know one of our institutional partners is looking for whatever deal parameters, we're going to go share that with our brokerage friends, and they're hopefully going to bring us some of those ideas that fit into that buy box of what that institutional group is looking for. Some of our programmatic ventures actually outline here's exactly what we want to go see. We're then able to go share that with the brokerage community, and then we'll get investment ideas based on that versus us just going to them and saying, send us everything that you're seeing, and we'll sift through it and get you feedback. We can actually be more specific and say, we really like to see this type of investment. And then again, they'll go out and share those ideas with us. But again, communication is key. We report on a quarterly basis, but we're communicating with folks much more frequently than that on a variety of standpoints.
And I absolutely love how you describe that communication as, kind of your marketing budget, especially in this business. That communication is really the most important thing at this point, because, in terms of marketing and word of mouth here, in acquiring new investors and kind of expanding upon those horizons, like that's going to be the number one thing that would lead to more investors coming in, and that positive word of mouth just kind of getting out there. But yeah, to kind of transition, just looking ahead at least for Rhino Capital, where do you guys see yourself within the next 5 to 10 years? What does that look like?
Definitely want to stay geographically focused. Don't know what the future holds, but I'm betting on Boston. I think Boston's going to continue to be a place that commercial real estate investment's going to want to be. We're going to continue to have innovation. There's going to continue to be wonderful companies that are spawning out of our university system, hospitals, leveraging the skilled labor force that lives here in these areas. So I'm delighted to be committed to Boston. Certainly things could shift, and if we have to go to different markets, we will. But right now, we're very much committed to staying in Boston. I pride ourselves on being very nimble. And so like I mentioned, we were in multifamily. That moved away from us a little bit. We quickly shifted away from that. Real estate is cyclical. I believe the pendulum always swings a little too far in one direction or the other. I think that it moved very far away from office. Certainly office is struggling for obvious reasons, but I don't think it's going to struggle forever. Retail during COVID, everyone was saying retail's dead. It's not dead. It's coming back in a big way. And so I think in the future we will get more involved in different product types, whether that be retail, hospitality, I don't know. The way that we're going to do that is we're going to partner with experts, groups that have done it over the last several decades. We'll partner up with them, sit shotgun, learn, and then hopefully be able to do it on our own account to build up our portfolio in those different product types. But in the immediate future, thrilled on what we're doing right now. We're seeing a ton of opportunity. Thankfully, we have wonderful investors that want to continue to invest with us. I put out an annual report every year to our colleagues and our friends. And in 2023, Rhino Capital sold 0 buildings in our portfolio. In 2024, we sold 7, I believe. In 2025, we're on that same trajectory of selling buildings. And so it feels like the market is thawing out. It was very illiquid for a long period of time. There weren't a lot of velocity of transactions. That feels like it's completely shifting. And 2025, I think, is going to be Rhino's best year yet, and look forward to continuing to grow. We had done smaller deals historically. When I mentioned above the mom and pops, but below the institutional folks, we were probably closer to the mom and pop range. And so we've sold off a lot of those buildings and replaced them with buildings that are much closer up here to the institutional investors. And in our annual report, we talk about that. Selling a $5 million building and replacing it with a $20 million building. We had 3 examples of that last year, and I think this year we'll continue that trend of maybe only still having about 30 investments, but our assets under management, the total size of our portfolio in terms of project costs, I believe is going to go up substantially.
Awesome. Sounds good. So just kind of wrapping it up, what advice would you give to someone like young professionals like us that want to start our own real estate investment firms? Any advice?
Yeah, don't do it. No, I'm kidding. Reiterating what I shared earlier, it's a very experiential and relationship-driven business. So what you can do when you're young is get in front of people. Just ask to talk about their experiences, their career trajectory. And the more you expand that network, the more comfortable you're going to be in venturing out on your own. In addition to that and how you can expand that network, I think it's a very easy thing for young people to do. Join those industry groups and go to the events that they put on. Some of the events are educational, some of them are just social, but it's a great way to meet a ton of people in our industry versus on a one-by-one basis. You should definitely do both. But I believe joining those industry groups, in addition, it develops instant credibility. Given the fact that you spent the time to join that group, that you're going to the event, showcases the person on the other side of the conversation, wow, this person really wants it. They're actually here. I can't tell you the amount of time I talk with folks and say, I really want to be in commercial real estate. And I say, great, here are 3 people that you should go talk to, and then they don't even take that step. So did they really want it? Probably not. People like me experience that a lot. And so showcasing that, hey, this is my passion, this is my purpose, is important. And joining those industry groups, I think, is a way, again, to develop that instant credibility to the people on the other side of the conversation. And then ultimately, like I said, there's no set path. And so if you feel like you're ready to go buy your first deal, do it. There should be nothing holding you back. Ask somebody to invest alongside you. Partner with somebody else. Again, there's no blueprint of this is what you need to do to go start your own real estate investment company. It could be an extremely small deal. It can be a big deal. Get in. It's experiential. Start experiencing it. Get into the blocking and tackling. And then I promise you that you'll learn along the way, get better along the way, and then you'll look back at some point and say, wow, I did it. It was great. But developing relationships, networking, getting out there, extremely, extremely important.
Awesome. So just lastly, how can students kind of connect with you if they want to reach out to you and learn more about what you do?
Feel free to email me, michael@rhinocre.com. I'd be more than happy to talk with anybody and hopefully be helpful and a resource as you continue to think about what your next step is outside of Bentley.
Awesome. Michael, thank you so much for being here. We really, really enjoyed the conversation and really appreciate it.
Lorenzo, Adam, it was my pleasure. If you guys need anything else, let me know.
Sounds good. Thank you so much.
Thanks,
Take care,
Michael.
everybody.